Welcome back. I'm John A.G., and today is not a cute little silver prediction show. Today is the pressure test, the plumbing, the deficits, the vaults, the paper claims, the export rules, the ETF flows, the things people scream about online, and the things that actually show up in the data. Because right now, everybody wants the big number, $300 silver, $500 silver. Some people are even throwing out $1,000 silver by 2034. But before anyone starts building castles on a price chart, we have to ask one brutally simple question. What is real? What is hype? And what would actually have to break for silver to move like that? And before we get into it, my YouTube stats show a lot of you watch these videos without subscribing. If you value this work, subscribe right now and drop a quick comment, even just John AG, so the algorithm knows this content matters. All right, let's start with the strongest part of the argument, because this is not just fantasy. Silver has been running in deficit, not 1 year, not 2 years. Reuters reported that the market is heading into a sixth straight year of structural deficit, with 762 million ounces drawn from inventories since 2021, and a 2026 deficit forecast of 46.3 million ounces, up from 40.3 million ounces in 2025. That matters because deficits do not scream on day one. They whisper. They take metal from stocks. They pull down the cushion. They make the market look calm right up until the cushion gets too thin. Then everyone suddenly discovers that silver is smaller, tighter, and more emotional than they thought. But this is where we have to be careful. A deficit is not the same thing as a guaranteed moonshot. A deficit does not automatically mean $300 silver. It does not automatically mean COMEX is finished. And it does not automatically mean every viral claim on social media is true. The clean version is this. The silver market is tight. The inventory drawdown is real. Squeeze risk is real. But the price targets are models, opinions, and scenarios. They are not laws of nature. Now, the big online argument is that official deficit numbers understate the problem because ETF and ETP flows are often treated separately from the industrial supply-demand balance. That point is important. If investment products keep absorbing metal, and if those products are physically backed, then the market can feel tighter than the headline deficit suggests. But there is a difference between saying ETF demand can tighten the market and saying the real deficit is definitely 1.4 billion ounces. That number needs a transparent calculation. If someone says the real hole is double the official version, fine, show the table. Show the starting date. Show the flows. Show what is vaulted, what is redeemable, what is recycled, and what can come back. That is the line I want you to remember. Silver can be extremely bullish without needing sloppy math, because the bullish case already has enough fuel. Industrial use matters. Solar still matters, even with thrifting and substitution. Electronics matter. Automotive demand matters. Defense, electrification, data centers, and investment demand all matter. But if prices rise too fast, the market responds. Users thrift. Scrap comes out. Jewelry demand weakens. Substitution gets funded. That does not kill the bull case, but it does change the speed. Now let's talk about the number that grabbed everybody by the throat. The claim that silver would be around $375 if COMEX had never existed. That is not a fact. That is an analyst argument. It may be based on a model. It may be trying to separate physical price discovery from paper market pressure. But unless the formula is open, testable, and consistent, we should treat it as a provocative theory, not a confirmed market price. Does paper trading influence silver? Of course it does. Futures markets influence price discovery. Leverage influences volatility. Margin calls influence liquidation. Shorts and longs both influence momentum. But the idea that one clean, provable, non-COMEX price is sitting at $375 is too neat. Markets are not that neat. The better question is not, what would silver be without COMEX? The better question is, at what point does physical demand overpower paper liquidity? That is the real battle. And that battle shows up in very specific places. Registered inventory, London vault availability, ETP holdings, lease rates, delivery stress, premiums, import flows, export controls, and whether industrial buyers are quietly locking down supply before the public realizes what changed. Now bring China into this, because this is where a lot of people are getting sloppy. China did not simply ban all silver exports. Reuters reported that China named 44 companies allowed to export silver during 2026 and 2027. That means control. That means permission. That means the gate is narrower and more political. But it is not the same thing as saying exports are completely banned. That distinction matters. A full ban is one story. A controlled exporter list is another story. Both can tighten psychology. Both can make buyers nervous. But one is a wall, and the other is a gate with guards standing in front of it. And in a market like silver, psychology is not a side issue. If you are a manufacturer and you think metal may be harder to source 6 months from now, you do not wait for the perfect headline. You bid earlier. You build inventory. You sign contracts. You take ounces off the market before somebody else does. That is how tightness becomes visible. Not all at once. First in premiums, then in delivery behavior, then in inventory movement, then in panic explanations after the move has already started. The sulfuric acid angle is technical, but it matters because silver is usually not mined as a standalone product. The Silver Institute data shows primary silver mines are only about a quarter of mine output, with the rest coming as byproduct from lead, zinc, copper, and gold operations. So when copper supply chains get stressed, silver supply can feel it too. Reuters reported that China is set to halt sulfuric acid exports from May after earlier quota controls, and that Chile depends heavily on acid for copper leaching. That does not mean silver instantly explodes tomorrow, but it does mean the byproduct chain deserves attention. Silver supply cannot respond like a tech stock. You do not just click a button and add 50 million ounces. That is why the silver market is dangerous when the crowd wakes up late. Mine supply is slow. Recycling depends on price. Industrial demand is sticky until it is not. Investment demand can appear suddenly, and when financial flows arrive in a small market, they do not knock politely. They kick the door. Now let's shift to gold, because gold is giving us a clue about investor psychology. The World Gold Council reported that March 2026 saw record global gold ETF outflows, led by North America with about $13 billion leaving, while Asian gold ETFs still posted strong inflows in the quarter, with China accounting for the bulk of Asia's Q1 inflows. That tells you something. The West was looking at rate cuts, real yields, and short-term positioning. Asia was looking at currency pressure, geopolitical risk, and the need for protection. Same metal, different reaction. Same global system, different survival instinct. And this is where many investors get gold wrong. They think it is only about whether the central bank cuts rates next month. No. The deeper question is real rates, trust, fiscal pressure, and whether people believe the currency is protecting them or draining them slowly. If inflation stays sticky, if deficits stay large, if bond markets demand higher yields, and if governments cannot tolerate those yields, then gold and silver do not need a perfect story. They only need doubt. Now, do not misunderstand me. Doubt does not mean collapse tomorrow morning. The IMF did not officially say every government should prepare for immediate financial system collapse. What the IMF did say in April 2026 is that global financial stability risks are elevated, with war, inflation pressure, tighter financial conditions, sovereign debt stress, non-bank leverage, and amplification channels that could turn market turmoil into financial instability. That is serious enough. We do not need to exaggerate it. When the official language already says risk is elevated, when public debt is already a vulnerability, and when markets are already sensitive to bond yields, adding fake drama only weakens the case. The real drama is already there. Debt is high, trust is thinner, geopolitics are hotter. Energy routes are fragile, supply chains are less efficient than people assumed, and every time a crisis appears, governments reach for the same tools. More support, more liquidity, more borrowing, more promises that tomorrow's growth will pay for yesterday's decisions. At some point, the market asks a dangerous question. Who is the buyer of last resort? And if the answer is the same institution that prints the currency, then metals start to look less like speculation and more like a referendum. That is why fiscal dominance matters. Fiscal dominance is when the debt problem becomes so large that monetary policy stops being fully independent. The central bank may want to fight inflation, but the government needs affordable funding. The bond market wants discipline, but the political system wants spending. And somewhere in the middle, savers start looking for an exit. Gold is the first exit door. Silver is the crowded, volatile, emotional second door. And if silver starts moving because both industrial users and investors want ounces at the same time, that is when price action can get disorderly. Not because every conspiracy is true, not because every forecast is right, but because a small market cannot absorb unlimited demand smoothly. Now let's talk tokenized silver. This idea is early, but it should not be ignored. Tokenized metal means a digital token that represents a claim on vaulted physical metal. In gold, Tether's XAUT is built around one token backed by one fine troy ounce of physical gold. And Reuters reported that Tether bought about 27 metric tons of gold in the fourth quarter of 2025. That does not automatically mean tokenized silver becomes massive. Silver has storage costs. Silver is bulky. Audits matter. Redemption rules matter. Custody matters. Trust matters. But if a credible tokenized silver product scales, it could create a new channel of physical demand. Think about that carefully. Industrial demand is one channel. Coins, bars, ETFs, and ETPs are another. Tokenization could become a third channel, but only if trust is strong and backing is real. Otherwise, it is just another digital promise in a world already drowning in promises. So the rule is simple. If it is tokenized silver, ask where the bars are. Ask who audits them. Ask whether redemption is possible. Ask whether one token really equals 1 ounce, or whether you are just buying a story with a silver-colored logo. Now, what about the so-called $300 club? There are analysts talking about numbers that would have sounded insane a few years ago. 300, 400, 500, some even higher. But the number itself is not the analysis. The path is the analysis. For silver to move toward $300, you would likely need several forces at once. Continued deficits, tight available inventories, strong investment flows, sticky industrial demand, less trust in paper claims, higher geopolitical stress, and a gold market that keeps pulling capital toward hard assets. Could that happen? Yes. Is it guaranteed? No. And that difference is everything. The mistake most people make is they hear a target and skip the conditions. They want the destination without studying the road. That is how people buy tops, panic on pullbacks, and then blame the market for doing what markets do. Silver is not gentle. Silver does not reward emotional leverage. Silver can rise like a rocket and fall like an elevator with the cables cut. So if you are new to this market, respect it. Do not confuse conviction with position size. Do not confuse a viral clip with a risk plan. And do not confuse being early with being wrong. The key question is this: are we watching a normal commodity cycle, or are we watching a monetary stress cycle begin to pull silver into a different category? Because in a normal commodity cycle, high prices eventually fix high prices. Scrap rises, demand cools, substitution improves, supply responds slowly, but it responds. The rally burns hot, then resets. But in a monetary stress cycle, people do not buy silver only because factories need it. They buy it because they no longer trust the measuring stick. They buy it because cash feels weaker. They buy it because bonds feel risky. They buy it because the system looks liquid until everyone asks for liquidity at the same time. That is the phase we need to watch. And I want to ask you directly, do you think silver is still just an industrial metal, or is it becoming a monetary stress signal again? Drop your view in the comments, because this debate is where the market psychology really shows up. Also, if any of you have done well in gold, silver, mining shares, or even simply by becoming more disciplined financially, share that success below. It helps other viewers see that patience and risk control are not boring. They are how people survive volatile markets. Now here's my base case. Silver remains structurally supported but violently volatile. The deficit story is real, but the extreme targets require confirmation. China matters, but do not call a licensing regime a total export ban. ETF flows matter, but demand can reverse. Tokenization matters, but only if the metal is real. The IMF warning matters, but do not turn elevated risk into a fake quote about immediate collapse. That is the clean framework. Bullish, but not blind. Alert, but not hysterical. Aggressive, but not careless. The next signals I would watch are simple. First, does the 2026 deficit worsen beyond current estimates? Second, do London and exchange inventories tighten again? Third, do ETF and ETP inflows return with force? Fourth, does China keep silver under tighter export control? Fifth, does the sulfuric acid disruption become a real copper and byproduct supply issue? And sixth, does gold keep attracting global capital even when Western investors hesitate? If those signals line up, silver does not need a marketing campaign. The market will feel it. But if the signals weaken, if investment demand cools, if recycling jumps, if industrial demand softens, and if liquidity improves, then the wild targets get pushed out. That does not end the silver story. It just means timing matters. And that is the part nobody wants to hear. You can be right on the big thesis and still lose money on the wrong entry, wrong leverage, or wrong time frame. So no, I am not here to tell you silver must be $300 tomorrow. I am here to say the structure is getting more interesting, the cushion is thinner than it used to be, the macro backdrop is more fragile, and the market is one serious demand wave away from discovering how small silver really is. That is the show. Not hype, not panic, structure. And remember, this is not financial advice. Do your own research. Know your risk. Know your time horizon. And never let somebody else's price target become your entire plan. If this breakdown gave you value, subscribe to the channel, hit the like button, and comment one thing you are watching most closely in silver right now. Is it China? Is it ETF demand? Is it COMEX inventory? Is it gold leading the way? I read the comments, and the best conversations usually start there. Because the next move in silver may not begin with a headline. It may begin with a small inventory change, a quiet premium, a policy adjustment, or a flow nobody cared about until the price had already moved. Stay sharp, watch the data, and do not sleep on silver when the system itself is starting to ask harder questions.